Hi, good afternoon, everyone. Thank you for joining us for this webinar, Navigating Leave, What New York Employers Need to Know About FMLA and Upcoming Paid Leave Changes. The presentation slides will be emailed to all participants by tomorrow, so please expect any presentations in your inbox. At the bottom of the screen, you will see several widgets for your use during the presentation. For example, if you have a question, please click the purple Q&A icon to the left. At the end of the session, the yellow certification icon on the right will become active for you to download your SHRM and HRCI credits. I'd like to take this time to just introduce myself. My name is Chris Calderi, and I am an employee benefits consultant with Corporate Synergies. For those of you who don't know, we are a health insurance brokerage firm, and we have, speaking today, Ellen McCann. Ellen joined Unum in 1997. She advises HR on all employment-related legal issues with particular emphasis on wage per hour compliances, leave of absence, military leaves, restrictive covenants, and employee relation issues. She also provides daily legal support to Unum's Leave Management Service Department, which provides leave administration services to its customers. Presently, Unum provides leave administration for over 200 state leave laws in addition to FMLA and covers more than 1 million lives. Ms. McCann received her BA from the College of the Holy Cross and her JD from the University of Notre Dame Law School. She is a certified trainer for SHRM and CE credits and is a frequent speaker on FMLA topic. At this time, I'd like to turn the conversation over to Ellen, and thank you all for joining the presentation.
Thank you, Chris. Hi, everyone. Thanks so much for joining us this afternoon. I think most of us can't get enough information about New York PFL, so we really appreciate you taking an hour or so out of your day and spending some time with us today. And for those of you who have been to a New York PFL presentation this year, and many of you maybe have, this may be the first one you have attended since we've had final regulations. So as you may know, the law itself was passed back in April of 2016. And in doing so, New York actually added a PFL benefit to its existing disability benefits law, or DBL. So the PFL and the DBL regulations and the bill are actually one combined bill, even though they provide for leave in two very different circumstances. That's relevant because you may hear me say at some point in time today that because they put this pseudo-employment and insurance law into insurance regulations, there are often times when it doesn't fit perfectly in that statutory scheme, but that's where it exists, and that's where we have to deal with it. We did receive final regulations back in mid-July, and so we do have a lot of answers to a lot of questions that we had prior to July. There are still, in my opinion, some open questions, and we'll talk about where those are as well as we go through. I fully expect that, similar to what we've seen in some other states, as we live with this new law, we may see the state of New York issue either FAQs or some information on their website that clarifies some of the issues that still exist. If you haven't had a chance to go out and look at their website, they actually have a really nice website on New York PFL, and they have quite a bit of information out there, both for employers, employees, and others. So if you haven't had a chance to look, you may want to go out and look because it is a pretty nice resource for you. The new program, so PFL benefits, will be available on January 1st, 2018. Okay, so PFL does not exist until January 1 in 2018. Any employee who works in New York is required to have PFL coverage, very similar to DBL. So if you have employees who are currently exempt from DBL coverage, they will continue to be exempt from PFL coverage. But any of your employees who are covered under DBL will have to have PFL coverage provided to them as of 1/1/18. And I'll talk a little bit more as we go about what does it mean to work in New York. We'll talk through some specific examples, work-at-home employees, that kind of thing. It doesn't matter where your company is headquartered. If you have one employee in New York who's working in New York and has done so for 30 days or more, you have to provide that employee with PFL coverage as of 1/1/2018. Okay? This will be a graduating benefit. It will become more generous as time goes by, but starting in January of 2018, Eligible employees will be entitled to up to 8 weeks of PFL at 50% of their weekly wage. However, that is capped at the state average weekly wage. So there is a cap that will apply to all employees, and employees who make more than the state average weekly wage cannot make more than that cap. And we'll go through that in pretty good detail as we go through the PowerPoint today. Like DBL, PFL can be obtained through an insurance company. So for those of you who have insured DBL products through an insurance company, the law provides that they have to provide you with PFL coverage as of 1/1/2018. Okay? Any insurance company who did not want to sell PFL in the state of New York had to exit the DBL marketplace. So any carriers that are providing DBL will have to provide PFL to their customers as of 1/1/2018. Unlike DBL, one significant difference with PFL is that PFL does provide job protection. So this is where I referenced earlier that this really is a hybrid insurance law and employment law, because it is providing job protection for your employees, such that when an employee takes a day off and uses PFL, you cannot performance manage them for that absence. You cannot take that absence into account even for no-fault attendance policies, and that employee is entitled to be reinstated to their same or an equivalent job when their need for leave is over. Okay? This is built, as I said, into the DBL legislation, and this will be added to your insurance policy as a rider at the beginning of the year. Okay? So whoever you have your DBL coverage with right now will be providing you with PFL coverage as of the beginning of the year. One answer we received fairly recently from the Department of Revenue is the taxability of employee contributions. And we did learn that employee contributions will be taken on a post-tax basis, and that benefits are taxable as non-wage income, which has to be included in federal gross income. So post-tax deductions and taxable benefits, taxes will not be automatically withheld from benefits, although an employee can request that they be withheld. And the employer is required to report the employee's contributions on the employee's W-2 as box 14. So I believe that's state disability insurance taxes. So that's a question that if you haven't been to a seminar or haven't read anything lately, that may be new information for you, because we just heard that from the Department of Revenue in the last week or so. So who is eligible for PFL? And the state actually defines this differently depending on how many hours the employee works. So for employees whose regular schedule is 20 hours or more per week, they have to be employed by you for 26 consecutive weeks before they're eligible to file for or receive PFL. Employees who work for you for less than 20 hours a week will not become eligible until they actually work 175 days for you. Okay? That does not mean that you can't withhold contributions from employees until they hit those milestones. So you certainly can go ahead and withhold employee contributions from day one of employment. You do not have to wait until the employee actually achieves eligibility to withhold those contributions if you want to go ahead and start withholding contributions. Employees will have to have this coverage. No one can opt out of PFL coverage with one exception. So an employee whose schedule is such that they will never meet those eligibility requirements is allowed to sign a waiver, and that waiver says that they will never meet the eligibility requirements, and they do not want you to take PFL contributions out of their check, and they will not file for benefits. Okay? Those are the only employees, other than those exempted from DBL, those are the only employees who can opt out of coverage of PFL. You may have an employee, for instance, who's older and doesn't have any family, who may say to you, I don't want you to take these contributions out of my check. I never intend to file for benefits. Legally, they have to be covered unless their schedule is such that they won't meet the eligibility requirements. So for instance, let's say you have an employee who's a summer intern. They will only work for you for 8 weeks in the summer. They'll never reach the 26-week consecutive threshold. That you have to tell that employee they have the right to file a waiver. You want to keep that waiver on file in case you get audited. And if that employee schedule does change for any reason and now you believe they will work for you for 26 consecutive weeks, you have 8 weeks to tell them that their waiver is revoked and that they are required to pay contributions. You may collect those contributions back to the date of hire if you so choose. One open question is, how do you collect those contributions retroactively? That has not been addressed by the state as of now. Okay, so those are the folks who are going to be covered under New York PFL. The plan structure, as I mentioned, does provide for graduating benefits. So as you can see, the benefits will get more rich every year, both in terms of the percentage of income and the weeks of PFL that will be provided to employees. So in 2018, employees are entitled to 50% of their income to a max of 50% of the state average weekly wage for 8 weeks. In 2019, that goes up to 55% for 10 weeks. In 2020, it goes up to 60% for 10 weeks. And in 2021, it goes up to 67% for 12 weeks. Always capped at the same percentage of the state average weekly wage, however. Now, these are fixed numbers. However, the state has said that it will keep an eye on how this plan progresses, and it may alter this schedule as we go along. But as of right now, this is the benefit schedule we can expect up until 2021. Okay. Contributions. According to the state of New York, PFL should be 100% funded by employee contribution. Their plan is that this will not cost employers anything, that it will be funded entirely by employee contributions. We believe that employers can pay the contributions if they choose, but that is not expressly provided for in the regulations. Okay? And it was not addressed by the Department of Revenue when they just published their guidance on taxability. Okay? The contribution is capped and it is limited, however, so employees can be required to pay 0.126% of their weekly wage, and that is capped at the state average weekly wage. So currently the state average weekly wage is about $1,306. And so the contributions can be capped at an annualized rate of $67,967.84 per year. Okay, so if you take that state average weekly wage, multiply it by 52, that's where you get the $67,000 and change. The reason that is relevant is because the state recently issued guidance that contribution maximum should be based on an annual basis, not a weekly basis. Okay? So originally, I think the thought was that there's a maximum weekly contribution of about $1.65, and the state has recently clarified that it's actually an annual maximum of $85.56. So I'll give you some examples because this does get a little confusing. Let's say you have an employee whose average weekly wage is $1,000. That employee's contribution is 0.126% of $1,000, or $1.26 a week. If you have an employee who makes $2,000 a week, that employee's contribution is 0.126% of the state average weekly wage of $1,306 because they make more than $1,306. So that employee's contribution would in fact be $1.65 per week. Okay? That's how contributions work. Benefits work in a similar fashion. So the employee receives 50% of their wages, capped again at the state average weekly wage. So here the maximum benefit will be about $653 a week in 2018. Let's use our example of our same two employees to make this seem more real. Employee A makes $1,000 a week. That employee's PFL benefit in 2018 will be $500 a week, 50% of $1,000. Employee B makes $2,000. So that employee makes in excess of the state average weekly wage. So that employee's benefit will be capped at about $653. Okay. Employees will not be able to receive more than 26 weeks of PFL and DBL in a rolling backward 52-week period. So I mentioned at the outset that PFL is part of the DBL statutory scheme. So even though employees can take this leave for very different reasons than they take DBL, it is a combined entitlement of 26 weeks for both benefits. Okay. So when can an employee take PFL? They can take it for bonding or placement. So bonding with a child who's been born, or they've adopted or placed with them for foster care. That leave has to be concluded within 1 year of birth or placement. However, New York did not limit PFL claims to births or placements that occurred after 1/1/18. They limited the employee's ability to get benefits to the time frame after 1/1/18, but they didn't limit their ability to file a claim for a birth that occurs beforehand. The only limit is that the bonding leave has to be complete by the child's first birthday or 1 year after placement. You may have an employee, therefore, that has a baby right now and goes out and takes 12 weeks of FMLA with you, and they come back to work at the end of the year, and as of 1/1/2018, they have a brand new entitlement of New York PFL. They can then take 8 weeks to bond with that same baby in 2018 because that PFL entitlement didn't exist when they took their bonding leave in 2017. The only contingency is that they need to be done with that leave by the child's first birthday. The next reason why employees can take PFL is if their family member has a serious health condition. The definition of serious health condition is very similar to the FMLA definition. However, the family members that the employee can take leave for is a much more broad category. So like FMLA, they can take it for parent, child, and spouse. But in addition to that, they can take it for parent-in-law, domestic partner, grandchildren, and grandparents. There is also no age limit on child like there is under FMLA. So under the FMLA, the employee can only take leave to care for a child if they're under the age of 18, or if over 18, they are disabled and incapable of caring for themselves due to that disability. Under New York PFL, they can take leave to care for a child of any age, regardless of whether they also have a disability. The last leave reason is active duty leave or qualifying exigency leave. This is leave that already exists under the FMLA, and it's leave that allows an employee to take time off of work if a family member is called to active duty in the military. And because of that call to active duty, the employee has to take some time off of work to take care of either an emergency or to attend an event. So things like military ceremonies, going to the attorney's office to change a will, counseling, anything related to the family member's call to active duty would fall here. Very similar to what exists under FMLA, but again, family members are more broad. So under the FMLA, employees can take active duty leave if a child, spouse, or parent is called to active duty. Under PFL, they can take it for those family members, but they can also take it for domestic partners and parents-in-law if they're called to active duty in the military. Okay, so let's talk a little bit more about some of the key provisions of New York PFL. And some of these issues were fleshed out much better for us in those final regulations that came out in July. So I talked about the coordination with DBL in respect to the fact that it is one 26-week entitlement. However, an employee can't take PFL and DBL benefits on the same day. DBL, you'll remember, covers the employee's own serious health condition, and PFL is going to cover the employee's family members' events. So PFL is not going to cover the employee's own serious health condition. Let's say you have an employee who happens to have a serious health condition and is caring for a family member with a serious health condition on the same day. they're not allowed to receive both DBL and PFL for that day. They have to choose which benefit they use. PFL will run concurrently with FMLA if the leave reasons are the same and they're both eligible for leave under both programs. The employee is eligible for leave under both FMLA and PFL, and you, the employer, designate the time as FMLA. So simply by virtue of the fact that you have an employee who's out on PFL for a reason that also qualifies as FMLA, that doesn't make it an FMLA protected absence. You still need to send out all of your FMLA notices like you do today. So your eligibility notice, rights and responsibilities, and designation notice in order for you to be able to count the time as FMLA. Let's talk a little bit more about who is considered to be working in New York. Any employee who physically works in New York is covered, even if they perform some incidental work outside of the state. The converse is also true. So if you have an employee who, let's say they work in New Jersey, and they do most of their work in New Jersey, and they're just incidentally in New York for work, those people are not covered because they're not considered to be New York employees. If you have an employee who has no other single state where they work, so let's say they work in multiple states, one of those states is New York, they are covered by PFL if they're based in New York, controlled from New York, or if they live in New York. Work-at-home employees. Let's say you have an employee who works at home in New York and reports into an office in Wisconsin. That employee will be covered by New York PFL. It doesn't matter where their headquarters is. It matters that they're actually working from home full-time in New York. If you have a more generous corporate paid leave program, you may have a 6 or 8 week paid parental leave program, for instance. You can allow the terms of that program to dictate how the employee is going to be paid if they're out bonding. So you can say to the employee, we have an 8-week paid parental leave program that covers bonding. You are going to need to take your PFL at the same time. We will do an offset from our program with the money you receive from PFL. So 50% will come from PFL, 50% will come from us, the employer, but we are going to mandate that you run it at the same time or concurrently, and we are going to say there's an offset from PFL. You also, if you choose to, you can have a more generous program than PFL if you want. You can file it with the state of New York and ask for them to approve it for you in lieu of you having to have a PFL plan. Most employers that I've talked to haven't gone through that length. They haven't had their programs approved. But if they do have a more generous paid parental leave program, they are looking at those plans to make sure there's an offset provision in the plan so that employees in New York can't take both the paid parental leave and New York PFL. If you have employers who work for you and other employers, they have the right to take PFL from both employers, but if they do, they have to do it at the same time. So let's say the employee's family member gets sick, they have to take PFL from you and the other job at the same time. Quickly, penalties for failure to comply with the New York PFL are very strict. If you do not provide coverage, you could be subject to a fine of 0.5% of your payroll and $500. You have to pay any claims that your employee accrues while you don't have coverage, and you have to either return contributions you've taken or forfeit your right to do so. If you pay PFL late, you are subject to a fine of 25% of the amount you didn't pay, plus $10 to the employee for each week benefits aren't paid. So very significant penalties if you don't provide PFL protection to your employees. So let's talk a little bit about FMLA and PFL, and I already hit on a lot of these issues, so we won't go through this in great detail. But you'll see there is significant overlap, but there are also places where you're not going to be able to run FMLA and PFL concurrently. The first place is eligibility. So employees have to work for you much longer in order to be eligible for FMLA than they do PFL. So you will have lesser tenured employees, eligible for PFL before they're eligible for FMLA. PFL also doesn't have a worksite requirement like FMLA does. So there's no requirement that the employee work at an office where there are at least 50 employees within 75 miles. Entitlement, when PFL is all said and done, it will be a 12-week entitlement, which is similar to FMLA. The only difference will be if you have employees who work more than 5 days a week, their FMLA entitlement will always be based on that work week. So if it's 6 days, they'll get 12 weeks times 6 days. But for PFL, that 12-week in 2021 will be capped at 60 days. So employees who work 6 or 7 days a week are always going to be maxed out at 60 days of PFL. Intermittent leave is also a place where PFL and FMLA differ. So for FMLA, you can set the minimum increment as long as it matches other types of leave, provided it's not more than 1 hour. PFL, however, has to be taken in full day increments. Okay, so very different from FMLA. However, if your employee is taking partial days of paid FMLA, you can aggregate those and deduct a full day from the PFL bank once an employee has taken paid FMLA in an aggregate that's equal to their normal work day. Okay? I think I talked pretty much at length about the differences in the covered leave reasons, as well as in the covered family members. There's also a distinction here for family members who work at the same employer, and this really is limited to spouses. So as you know, under the FMLA, there are spousal sharing rules where you can require spouses to share their entitlement if they're bonding, taking care of an ill family member, or for military caregiver leave. Under New York PFL, you can't limit them to their entitlement. They both receive their full entitlement, but you can limit them to taking leave at the same time. So let's say both mom and dad work for you. You can tell them that they can't be out on bonding leave with the same baby during the same time frame. They each still have 8 weeks to bond, but they can't take that time at the same time if you want to enforce that rule. Accrued paid leave time is a little bit different than those employer policies you have that aren't based on accruals. So if you have accrued paid leave time such as PTO or sick or vacation, under FMLA, you can force your employees to take that while they're on FMLA before they take unpaid time. You can follow that same rule if you have an employee who's on PFL that is also running concurrently with FMLA. However, if you have an employee who's on PFL only, you cannot require them to use PTO to get to 100% pay, but you can allow them the choice to do so if they want to. Okay? Shutdowns or closures, for PFL, any day in which you're closed, and this really refers to a holiday, not the weekend, can still be considered a day of PFL. I don't know why your employee would call out for PFL on a day you're closed, but nonetheless, if they do, you can count that. Whereas under FMLA, you can only count that day if they're taking a full week of FMLA, not a partial week. So let's just run through a couple of scenarios to show you how PFL and FMLA will interact for you with your employees. So let's do employee number 1 gives birth on June 1st, 2017, and she receives STD and DBL benefits from June 8th until July 13th, so that's 6 weeks of DBL. She's going to be on FMLA from the day she gives birth, which is June 1st, for 12 weeks, so that will exhaust on June 24th. Okay? So she's completely exhausted her FMLA. However, on January 1, 2018, she now becomes eligible for New York PFL. Okay? And she can tell you she wants to take her bonding leave for the same baby. She already was out in 17 for FMLA. So she's going to start taking leave from February 15 through March 15th, which is 4 weeks. But she still has 4 weeks of PFL in the bank for bonding. She is going to tell you she's going to start taking that in April because you can't require continuous bonding leave under PFL. So she has 4 weeks left. She's going to take that in April and take it through May, another 4 weeks. This is perfectly permissible because she has taken all this time before the first birthday of her baby, which would be June 1st, 2018. Second scenario involves a gentleman who has a grandparent who has a serious health condition. So he starts taking New York PFL in February of 2018, and he takes every Monday and Friday off to take care of his grandmother, and he does that for a certain period of time, and then he realizes that his grandmother's illness requires him to take full PFL. So he switches from intermittent every Monday, Friday to taking full time off to care for her. And as of May 1st, he has taken all 8 weeks of his PFL. Okay? That was PFL to care for his grandmother, and he was paid at 50%. However, because grandmothers aren't covered family members under the FMLA, he still has 12 weeks of FMLA in his bank to use for an FMLA qualifying reason. The same employee is injured in a car accident, and he's hospitalized for several weeks. He now files for FMLA and DBL for his own serious health condition. He is entitled to 12 weeks of FMLA, but he's only entitled to 18 weeks of DBL instead of 26 because he already took 8 weeks of PFL in the prior 52 weeks, and that maximum entitlement of DBL and PFL is 26 weeks. Okay? So those two scenarios just show you a couple of different ways you can see FMLA, DBL, and PFL interact. Okay? Quickly, what are some of your responsibilities as an employer? You need to display a poster in your work sites regarding PFL leave. The state has not yet updated the poster to give us information on what this will look like. So stay tuned. We expect to see that from the state. You also have to add information about PFL to your handbook. So if you have an employee handbook, you need to add PFL information to that. If you don't have an employee handbook, you have to physically give a copy of this to your employees. You have to continue your employees' group health insurance benefits while they're on PFL. And the key here really is maintenance. It's similar to FMLA. You have to maintain the benefits they had before they went out. So if they have a family plan, you have to continue a family plan while they're on PFL. If they had no insurance for whatever reason, you do not have to provide them with insurance while they're out. You also can require them to contribute or continue to pay their own part of the premium for that. The employee is entitled to be reinstated to their same or a comparable job upon the need for leave being over. And you must make sure you educate your employees about their rights. So if you have an employee who comes to you and says, my grandfather is sick, you have to proactively explain to them that they may have rights under New York PFL to take time off to care for that grandfather. Okay? So very complicated, right? This is fitting into what we already know is a very complicated landscape of leave laws in general. We have the FMLA. We have over 225 state leave laws that apply to employers who are spread out throughout the country. So what can you do? Is there help out there for you if you need it? And the answer is yes. You can outsource your FMLA administration as well as your PFL to a carrier. I can only speak to Unum and what we provide for FMLA services. But if you are interested in outsourcing, speak to your corporate Synergies representative and they can answer any questions you might have about FMLA outsourcing. But again, I'll just tell you a little bit high level about Unum's products so you get a feel for what outsourcing is like. So from Unum, we started FMLA outsourcing in 2000. We have 1.6 million lives covered with our product, so 1.6 million employees across the country have Unum administering their FMLA for them. In addition to, as I said, FMLA, we're administering over 225 state leave laws as well. And because the law changes so quickly in this area, you really need to constantly scan for legislative activity because new laws are passing virtually daily. So we're making sure that we're continuing to scan and make sure that our product is compliant up to the minute, because sometimes when these laws pass, they're immediately effective. We also provide for our clients training, support, and guidance. So training for HR support or HR staff on the regulations, culture change assistance, because we understand that when someone outsources, there is a little bit of a culture shift for their employees, so we help with that as well. We do have fraud investigative services. So if one of our customers believes that their employee fraudulently obtained FMLA, we can investigate that for them. We can also do any employer-specific leaves. So for those of you who might have that 6 or 8 week paid parental leave program, for instance, we administer those for our clients as well. And we provide real-time reporting. So an up-to-the-minute dashboard that shows HR who's been approved for leave, who's coming back from leave, who's out this day, whatever it might be. And finally, our program has complete indemnification. So if we make any mistakes that result in any damages to our clients, we reimburse them for 100% of that damage. There's no carve-out and there's no cap on that indemnification. One of the things we look forward to is we like to consider ourselves an extension of our client's HR department. So we take care of all of the required notices under the FMLA, as well as providing that robust tracking and reporting mechanisms. Okay? And finally, because this is such a complicated area of the law, we have dedicated legal resources that provide legal support to our Leave Management Center. So we have 3 full-time employment lawyers who support the product. Together we have it's over 55 years of employment law experience. We only do employment law, so we understand the interplay between FMLA, ADA, workers' comp, other employment statutes. We make sure our database is compliant and up to the minute, and we also make sure we're available to our clients at any time if they have any questions for us. So that's a little bit of a snapshot of Unum's offering. Again, if you're interested in outsourcing, you can talk to your corporate Synergies partner and they can answer any questions you might have about outsourcing. But I do think with PFL and other laws on the horizon, outsourcing really makes great sense for employers because the landscape is only getting more complicated. It's not getting any easier for HR. So something to think about if you're struggling with how to comply with some of these complex laws. So with that, I am done with the formal presentation. Chris, I don't know if you have any questions you want to ask at this point.
Yeah. First of all, thank you so much for
Sure.
for speaking today. That was great. One question that came in and definitely want to talk about is relating PFL to PTO days. And if an employee is on FMLA or PFL, how does it coexist with PTO days? And are employers able to charge full PTO days to offset the PFL payment?
Great. So I flipped back to the chart so everyone can see, and it's the coordination with employer accrued paid time off. So any time that accrues for the employee, so PTO, sick time, vacation, the employee has to work for you for a certain amount of time to earn it or accrue it. For FMLA, you can require them to take that before they go unpaid, right? That's the FMLA rule, always has been. So if you have a PTO plan and your employee's on FMLA, you can say, employee, you got to use all your PTO while you're on FMLA, and when you get to unpaid time, you may still have job protection, but you won't be paid. If PFL and FMLA are running concurrently, you can follow the same rule. Okay, so you can say, employee, 50% of your pay is going to come from PFL. You need to take another 50% from your PTO bank to get you to 100% pay because you're on FMLA, and FMLA rules are going to trump PFL in this regard. Where it starts to get tricky is if the employee is on PFL only. Let's say they're caring for a grandparent or a grandchild, so you can't run FMLA because those aren't covered leave reasons. There, the employee gets the choice whether to use PTO to get themselves to 100% pay or just use PFL to get to 50% pay and save their PTO for later in the year. So it mirrors your FMLA policy. If your FMLA policy says paid before unpaid, you can enforce that if FMLA is running concurrently. But if FMLA is not, the employee is going to be able to choose how they want to take that PTO time or not take it while they're on PFL.
Great, thank you. Another question that came in is relating to self-insuring for DBL. If a current company has self-insurance for DBL, does Unum or do they offer standalone coverage for the PFL?
Right. So Unum does not have an offering for standalone PFL because it is a rider on an existing DBL policy. So because it's a rider, you have to have DBL and PFL with Unum, and the funding mechanisms have to match. So fully insured DBL, fully insured PFL, or vice versa. I do know that it's at least possible legally to have self-insured DBL and fully insured PFL, but I am not aware if any carriers are offering that. I don't know, Chris, if you know the answer to that. I know we don't have that offering right now at Unum.
Yeah, no, I appreciate that. I believe that we haven't heard much either about that. I think it's concurrent with what Unum is doing as well. One other question that did come in as well was relating to intermittent leave. So if an eligible employee wants to partake in intermittent leave, but their employer has a more generous, paid paternity leave for the employees, how does the intermittent leave coexist with what the employer is offering if it's more generous?
Right. So what an employer can do, so the employer can't prevent the employee from taking intermittent PFL for bonding, right? That right exists to the employee. But what the employer can do is limit the employee's ability to get the more generous paid parental leave. So what the employer could do is say that if you want to receive our benefit, whatever it might be, 100% at 6 weeks, you have to take that time continuously or consecutively. The employer could also say we're going to offset from our benefit any time you receive from PFL or that you would be eligible to receive from PFL. We think that's a way that employers, although they can't stop the employee from taking the PFL in intermittent increments of 1 day, they can control when they'll pay their paid parental leave benefit. So you can't control the taking the PFL, but you can control when you'll pay them your benefit. And you can control when you'll offset your benefit by what they're taking for PFL.
All right, thank you. One other question that seems to be coming in a lot is about the penalties for an employer and what they face. What can you gloss over again what we talked about with the penalties related to the employers and what they face by not complying?
Absolutely. And I'll say before we start, if you already have an insured policy for DBL, your carrier should be providing you with PFL as of 1/1/18. They're legally obligated to. So hopefully all of the carriers will be complying with that law and you don't have to be concerned about this. However, if for any reason you're not providing coverage, the penalty is 0.5% of your payroll and $500. Okay, so that can be pretty significant, 0.5%. As well, the employer is going to have to pay the claims that the employee might have during the time there was no coverage. If they've taken contributions from the employee's paychecks, they have to return them. If they haven't taken contributions, they forfeit the right to do so for the time during which they didn't have coverage. So very significant penalties. If the employer pays PFL benefits late, the penalty is 25% of the amount not paid on time, and that's paid to the state, by the way, and $10 paid to each employee for each week that employee's payment was late. So not quite as significant penalties on the late side, but certainly still could be pretty significant depending on how long the employer waits to pay those benefits to their employees.
Thank you for that. That was a clear overview of that. Other questions that we're getting in are a couple people talking about the discrepancies between union and non-union employees. Some employers that have union employees that are getting benefits from the union fund, but they want to know how it coexists with the benefit that they're getting from non-union employees, and if there's any sort of discrepancies between the two.
Mm-hmm. So if a union has a CBA that provides an employee with benefits that are at least as great as PFL, they don't have to have a formal PFL program. Okay, but that program that the union is providing has to be at least as generous as what's provided for under PFL. Okay, so it's perfectly okay if you have an existing CBA with your union and they already provide benefits at least as rich, then they can go ahead and continue to do those, okay? And that's fine. And the CBA will govern, whatever those rules are for the employee. If the public employers more often than not will have unions, public employers are not required to have DBL or PFL, but if they want to opt in, they certainly can. If there's no union, the public employer has to give notice to their employees and the state 90 days prior to the plan being effective. If there is a union and the union agrees to have voluntary PFL coverage, then notice only has to be given to the state. So I think that answered the question, but if it didn't, please let me know.
Yeah, I'll keep an eye out for any response on that.
Yeah, so it may be in that case, it may be that you have a unionized and non-unionized population, and this may be what they're getting at. The union can have its own CBA that provides benefits as generous as PFL, but for your non-union employees, you will have to get PFL coverage for them if they're not covered, obviously, under that CBA.
Okay. Also, just to confirm again with the employees who work in New York, if there's one or more employees in the New York region, you do have to offer New York paid family leave, correct?
Correct, to that employee. So you don't have to offer it to your employees in other states, just to the employee who is working in New York. And the requirement is once you have one employee working in New York for 30 days, you have to have PFL coverage for that employee that works in New York.
A little bit about the communication of PFL and the employee handbooks. Is there any regulations around stating that within the employee handbooks and getting that information out to your employees?
Yes, so the regulation is clear that if you have a handbook, information about PFL has to be included in that handbook prior to 1/1/2018. What a lot of employers will be doing is taking the state model notice once we get it and actually placing that in their handbook. The benefit of that, obviously, is if the state challenges your notice, you can say, well, we used yours, so how can you find fault with it? So a lot of employers will take that poster, not only post it physically in their locations, but also put that exact poster in their employee handbook. But again, we don't have that yet. We're expecting that from the state fairly soon.
And for an employee to be, before they can get paid for PFL, what is the requirement, the eligibility requirement?
Yes, so in order to be eligible, if they work 20 or more hours a week, they have to work for you for 26 consecutive weeks. And if they work less than 20 hours a week, they have to work for you for 175 days.
And before they get paid on the PFL, do they have to be out of work for 7 days, or is it greater than 7 days?
No, that's a great question. There's no waiting period for PFL like there is for DBL. So benefits can be payable on day one missed. They have 30 days to file a request for payment with your carrier. And then they will have to provide to the carrier some type of medical certification or proof that they had a covered event. So if, let's say it's bonding, proof that a child was born and they're the parent. The carrier then has 18 days to pay them once they file the completed request. You can, as an employer, also require, though, that they give you certain notice. So you can require they give you notice of the need for PFL leave for foreseeable leaves at least 30 days in advance. So if you have an employee who's having a child, for instance, you can require them to tell you 30 days in advance of at least their expected delivery date. If you have an employee who has an event that's unforeseeable, let's say their husband got in a car accident on the way to work that day, you can require them to tell you that they will be absent and they need PFL as soon as practicable. So either that day or the next day, depending on what's practical given the circumstance. Very similar notice requirements to what we have for FMLA right now.
And jumping back real quick to the eligibility with the 175 days you mentioned before, are those 175 days consecutive, or can they be, can they be broken up?
Yeah, they are not consecutive. So any 175 days. What's interesting is it doesn't say 175 days in what period of time. There's no limit for eligibility. However, for waiver, the waiver says if you have an employee who won't work 175 days in 52 weeks, they can file a waiver. So at least in theory, you could have an employee, if they wanted, paying into premiums, paying contribution, and achieving that 175 days after 2 years of employment with you. We don't know why employees would want to do that, because they're paying for a benefit that is going to take them a long time to be able to use. But there is no time frame for them to reach the 175 days for their eligibility.
Great, thank you. A little bit about the PFL forms and what you have to do to get the accurate forms for PFL. Can you elaborate a little on what forms they need and when in fact they need them?
Right. So there will be claim forms, final claim forms published by the state. There are drafts out on the state website right now, but we're waiting for them to finalize those claim forms. And the state has said that they'll have a model form and that it will be available either out on their website or out on your carrier's website as well, so you can easily get access to that. And the employee will have to fill out that form. Now, carriers can also request information in a different form. So let's say we decide that we don't like questions 5 and 6 in the sample form, and we're going to ask for the same information, just slightly different wording. We can have our own form as long as we don't ask for more than the state form requires. But the employee is always going to have the option to not use our form and use the state form. So I think most carriers are going to just go ahead and use the state forms because we're going to have to take them anyway. But those will be published by the state, and we'll get a chance to look at that. For those of you who haven't had a chance to look, the website is www.ny.gov/programs/ and this is all hyphenated, New York State Paid Family Leave. So if you just want to Google it, you'll find that pretty quickly. But the draft forms are out there, and we're expecting the final forms to be posted in a pretty easily accessible place out there once they're finalized.
Great. One other question was also around the situation of having a child this year and then taking the benefit once it goes into effect in 2018. Can you elaborate a little more on who can take that benefit and when in fact they can do it?
Right. So any employee who's already eligible with you for benefits as of 1/1/18, so if they're 20 hours or more, they've worked 26 weeks already, or if they're less than 20, they've worked 175 days, they will be eligible to take this benefit on 1/1/18. Okay, so they've met the eligibility requirements. The benefit is theirs. Let's say they had a baby in July of 2017. And they're eligible for FMLA. They took all 12 weeks of FMLA. They will be eligible to take 8 weeks of PFL starting 1/1/18 as long as they're done with their leave by the child's first birthday. So let's assume the baby is born July 2nd. They have to be completed with that leave by July 2nd, 2018. Doesn't matter, though, that they already took leave in 17 for the same baby. Doesn't matter if their FMLA time is exhausted or if they've exhausted your paid parental leave policies. So when they start taking this leave in 1/1/2018, the only thing you will deplete from them is their PFL bank. FMLA bank's already empty. You don't have to give them another provision of your own paid parental leave policy if it doesn't provide for more leave. But you will have to provide them with New York PFL.
Okay. One question that came in as well is, how does an employer pay the employee with PFL?
I'm sorry, I missed the beginning of that.
How does an employer pay the employee for its PFL?
Okay,
benefit?
so it depends on how you're insured, right, and what your agreement is with your insurance company. At least for us at Unum, it will mirror what we do for DBL. So for instance, we have some DBL clients who we pay the employee directly the DBL benefit. We have other DBL clients who might have a more generous STD provision or salary continuation, for instance, and they actually pay the employee their salary, and then we reimburse the employer for DBL. We will be handling PFL exactly the same way. So for those customers of ours who they want us to pay their employees directly, we'll pay their employees directly the PFL, so the check will come from us, from Unum. Other employers who may have, let's say we have a lot of employers that have an 8-week paid parental leave policy. Those employers are choosing to pay the employee's salary directly for 8 weeks and then claiming reimbursement from us for the 50% portion that would have been PFL. So it really depends on what I am assuming your carrier will mirror the DBL structure you have now.
Okay. A little bit about deductions as well. Another, hot topic that's kind of a big question is, should employers wait for new employees to reach their eligible hours before they start deducting? The deductions should start. So, do the eligible hours need to be met before deductions should start? And maybe you can elaborate a little more on when deductions should be started. When deductions typically should start, and when this will be billed.
Okay, so legally, employers could start taking deductions on 7/1/17. That's how the law is written. However, my interpretation, at least, is that provision is, although not limited to self-insured employers, was really geared for self-insured employers who need to have some money in their trust fund to pay claims that will come in on 1/1/18. So for the most part, most fully insured employers really aren't going to be in a big hurry to start taking deductions much sooner than 1/1/18. But they can if they want. It's their option. But for the most part, at least what I've recommended Unum, the employer, to do is we're going to wait to take those deductions because most carriers are going to bill quarterly in arrears for PFL. So if you start taking deductions right now, you won't have to pay a bill for quite a while. So your choice, though, as an employer, but most employers are waiting. The other reason most of us were waiting is we didn't know about taxability until just last week. So we didn't know whether it was post-tax contributions or how we were supposed to do the contributions, right? And we also, at least for my advice for Unum HR, I want to wait until we have a sample notice so we can tell our employees what we're taking these contributions from their pay for, right? So although you could take it 7/1, your choice as to when you want to take it. A lot of employers are starting on 1/1/18. They'll have enough premium stored up to pay that bill that's going to be in arrears for the first quarter. As to when you want to start taking it from an employee once you're already taking it from everyone, you do not need to wait till they make the eligibility, till they meet the eligibility requirements. Let's say you're an employer who decides to start taking contributions on 1/1/18 from all employees, and you hire a new employee on 1/10/18. You can start taking deductions that very day that they're hired. You do not have to wait for 26 weeks to take the deductions.
Absolutely. Thank you so much. Appreciate it. Ellen, I think we've hit pretty much the end of the webinar here. I wanted to thank you, of course, for your time, and it was great information. We do have SHRM and PDC and HRCI credits that can be downloaded now by clicking the yellow document icon. So for anyone that wants that, it's to the right of the widget bar on the bottom of your screen. And as you exit the webinar, please take a moment to complete the brief questionnaire that appears so we can address any feedback you have for us. And any further questions can be sent to Ashley Whelan at corpsyn.com. That's ASHLEE.WHELAN corpsyn.com. There's a lot of questions that everyone had for us. We hope we got to as many as we could, but we definitely want to answer any more outstanding ones you have, so please reach out. We'd be happy to respond. Thank you all for joining. We really appreciate it, and we look forward to talking with you more in the future. Ellen, thank you again.
Thank you.